Hello, everybody. This is Toni Turner, and welcome to the market now as of Friday, October 20th, right at the market's close. Well, Wall Street's main indexes dropped today as U.S. Treasury yields are hovering near multi-year highs following hawkish remarks by Federal Reserve Chair Jerome Powell, and while the Middle East conflict is keeping investors jittery. We all know that. So on that note, let's go on to three charts that could give us some insight into the week to come. As we always do, we're going to first start by looking at a daily chart of the S&P 500 SPDR, symbol SPY. As you all know, this is the exchange-traded fund that closely follows our benchmark S&P 500 index. Now, today, when I captured this chart at the close, the SPY was trading at $421.44, nearly 12% below its all-time highs at $479.98 in January of 2022. Now, since right here, we remember this gap open we had right here on July 27th, we had a real good uptrend in this past year. Then the market gapped open on July 27th and made an intraday high at $459.44. And of course, as you guys know, this high has remained the high since the high, and we call it a relative high because the highs on either side of it are lower, but it is not the all-time high. That was, as I told you, in January of 2022. So starting July, the SPY said, all right, we've had a nice year, but the party's over. And it dropped down to the down through the 20-day moving average, the red line, the 50-day moving average, the green line. It dropped down to actually gap open to the downside to open at $433.37. Now, from there, it rallied up to its September 1st high at $453.67. Then on September 7th, it fell to about $444, pushed up to $451, and then said, all right, I can't do this anymore. And how do you know that the market's weak? When it pushes up through this 20-day and 50-day, you say, oh, good, things are better. Yeah, you do, but then when it started coming down, dropped through the 50-day and the 20-day and made a lower high, see, a lower high, that tells you that buyers aren't as steady, that they're selling sooner, that the shorts are coming in faster, so that gives you weakness. Lower highs tells you the market or the stock, whatever it is feeling weaker. So again, it dropped down from this September number here at 451, it dropped hard from there down to the 200-day moving average, trading at 420, 421. Now, it danced along these days. Then we had a real positive day on October 6th. It was like, oh boy, it seemed like everybody had a fresh beginning. And that was the Friday right before the unfortunate war in the Middle East began. So the market managed to push up that following week. We had this positive day on October 6th. Again, that was the Friday before the Israeli-Hamas war began. And the market rallied for a few days, but then it hit its head right here on the 50-day moving average at about 438. Right here. It made about a 438, and it said, all right, I can't keep going any longer. And it started falling down to where we are today. It fell through the 20-day moving average and down here. Now you see that the 200-day moving average, the price of that now is $422.29. And the close today, or near the close, is $421.44. So we've been talking about if it could just stay above the 200-day moving average, because that's kind of a negative thing when the market's trading below it. And it's not way below it by any stretch. It just fell back down here today to 421, which is pretty well even right now. with the September, the end of September lows, and we can even stretch this line over further and get some more price support there. So this is important. We've been talking about, again, that the 200-day moving average is key support. If we go down from there, we're going to go down to the next, we're going to go down to 420, which is just below where we are, so it kind of doesn't count. Then we can go down to the 415, 416 level if we move all the way across this chart and look over in this direction. Now, think of something with me here. When we talk about price support and even moving average support, those of you who are new to the business know that price support, if you can think of it like a tennis net on a tennis court, and you know how that net is a very definite boundary between each side. It splits the court in half, and it's a very definite boundary, that net. However, if you walk up to that net and move it, you can move it with your hand back and forth, and it will go back and forth. It has some give in it a little bit each way. So these price support levels, just like price resistance, same thing. We see that right here, right below the 50-day moving average here. The 50-day is pretty strong, and if it's coming down overhead, it can really put a hitch in the giddy up of price. So when I talk about price support and resistance and moving average, same thing. Think of it like a net on a tennis court. It does have some give in it, so there's a little, obviously, with so many people trading, investing, black boxes going all at one time, nothing is going to be exact. It's amazing to me many, many times how exact the market can be. But we do need to hold this 420 line in our minds as a very key support level when we go into next week. And next week, a lot of big companies are going to be announcing earnings. If it makes you feel any better right now, I will remind you that we talked about this last week. November, December, and January are seasonally the 3 most positive months of the year. So fingers crossed, I'm going to hope that's true this year as well. Okay, our next chart today is a daily chart of the Invesco QQQ, symbol QQQ. As you all know, this is the exchange-traded fund that follows our NASDAQ 100, an important index in our markets. It's the top 100 non-financial companies by market capitalization, of course, including companies like Apple, Amazon, NVIDIA, Tesla, that whole group. Now, when I captured this chart today at the close, the QQQ was trading at $354.60, about 13% below the all-time highs in November 2021 at $408.71. Now, I'm sure you all know and remember that we enjoyed a very good uptrend this year. You can't see the January numbers on this chart, but from January lows at 262 on the Qs, all the way up to this relative high in July at $388. That was a sweet move all the way up. That became the relative high. From there, it fell. It tried to make another high and couldn't see how it used the 20-day moving average as support, but it made a lower high, and that's your clue that whatever you're looking at when it makes a lower high may be saying, all right, I'm getting tired. I got to pull into a rest stop here. So at this point, the Qs fell down here, fell down to the August 18th low that gapped down to 354. Then, just like the SPY, moved back up to the September 1st highs, in this case at 381. Then slid down to 351. Where am I now? In September. Slid down to $351.36 on September 27th, so we're down here. Then consolidated for a couple of weeks at the 353.54 area. So this created quite a level here of consolidation of price support. We see it here, we see it here, and we can draw a line. If we can go that way pretty straight, we can see it here. So this area here of 354, 355, this, you can see how this has become key support. And by the way, most technologists will call it key support if it's touched the level more than 2 times or 3 times or more. Now on October 6th, right here, we had the same kind of really nice mood-changing day in the market. The SPY had the same day of kind of almost an outside day here, very positive day, and we were all breathing sigh of relief. That was the Friday right before the Middle East conflict, if you want to call it, began. So it was good, though. The Qs managed to rally in the upcoming week from there. They climbed up to 374 on October 12th, then started giving way again, and gently fell down back below the 50-day moving average, the 20-day coming in at 362, and again back down today to where it closed at $354.60. Now, as I said before, this is a key support level, and we can draw the line, as I just did, all the way over. Just remember, I mean, if it does go below it, what was support becomes resistance. It'll have to climb up back through it, and there's nothing to say that that won't happen. But that's the thing, when you get numbers this strong, 353, 354, 355, once you get below it, then you got to be tough to get back through it. So, well, we've got earnings coming, and it may happen sooner than later. So, again, next week we're diving more deeply into earnings season. As I said, the big tech stocks are going to start announcing next week. So looking at this, we talked about a triangle last week, and we see here that at some point here it's going to break. And it's okay. If it goes to the downside, it will create really great opportunities for us. So trade wisely and consider using protective stops. Okay, now I will be honest with you, as I always have been. I looked at many exchange-traded funds looking for something for us to trade next week. At the moment, I didn't see anything that was really beautiful. Of course, we'll have new opportunities next week when we get more deeply into earnings season, but it could cause more volatility. We've got a lot going out there in our world right now. But I did come across the Invesco Biotechnology and Genome ETF, which usually doesn't care very much about where the market's going. But it doesn't look overjoyed right now, but I'm not sure if this could possibly come in as a bottom fishing vehicle or not. It depends on what happens, so let's look at it. Again, this is the Invesco Biotechnology and Genome ETF, symbol PBE. It has 31 holdings. I like the top holdings, although at the moment this is certainly down. Amgen's up. That's the biggest one here. So the top holdings are Amgen, Vertex, Gilead, Biogen, and United Therapeutics. Now, when I captured this chart today, the PBE was trading at $55.47. That was right before the close. Now, you can't see it on this screen, but just so you know, the PBE made an all-time high in February of 2021 at $84.86. So if it starts up, it has room to go. In the big picture, if you look at it, and you go look at a monthly chart, in the big picture, we could say it was a victim of COVID because it was up at that high at 84.86 and then fell pretty dramatically into May and June of 2022 to the lows at about 51. Then think, when we look at the left side of this chart, think in your mind, fast forward to where we see it making a high in February of 2023 at 68.50 right up here. Then it fell down from there. It fell pretty hard the beginning of this year. Fell down here to March lows, actually a double bottom. It fell through the 50-day, the 20-day. You can see how that fell down through the 200-day. Oh boy, down here, and made a little double bottom here. And these lows are right at the 60 line. Okay, so that was support for this. It jumped up from there to nearly 65 in April, and then traded in a range. It traded in a range here for quite a while. This is a disorganized range for sure, but it stayed in a pretty darn good range at about from 60 to about 64 or so. It just traded in this range all the way through. Then it finally started backing off in August. Remember when I said if something makes a lower high? Well, there's a lower high right there. So in August and then September, it made two lower highs from there to there, close, but still a little lower. And so it lost steam, and then it fell pretty hard here, back down through the 50 and 20-day moving average, back down to the October lows to $55.19. That's where, and right now, today, it's trading at $55.47. So October 4th, it was $55.19. Now it's trading at the low, it's closing at the low of the day today, so it could have farther to go. I just wanted to give you something to stare at if you need to next week. Because if you look at this longer term chart that I talked about before, there is price support in the 50-55 area, long-term price support. So whether it can hold or not, we will see, but again, it's something to look at. If in the coming week the market becomes relatively positive, and of course none of us know what's going to happen in the coming week, but if it becomes relatively positive and if the PBE can stay above 55, okay, it needs to stay above 55 for me. If it can do that, I may add a small position to my trading portfolio. With my stop is going to be in very tight here, very tight at 54.80. I'm not looking for something that does a dive, and I'm not going to do that. So my stop's going to be at 54.80. If and when the PBE can move above these little pivot highs here at 58 and stay above them for 3 trading days, I will add to my position, and of course by then my stop will be a trailing stop. So you may want to keep an eye on the PBE in the coming week. Now, if you'd like to become a more successful trader, this is the perfect time to check out my online training programs. You can choose from 10 different programs, including our popular flagship product, 7 Steps to Successful Trading. Everybody likes that one. You can also learn how to swing trade successfully. We've got a great program I like, Trade the Trend to Profits. How to read charts is great for novice traders. 3 winning setups, great for short-term traders, and kind of like what we're doing right now if it goes through, how to bottom fish like a pro. So check out these timeless programs. They will show you how to elevate your trading skill set, which means you'll learn how to increase your gains quickly and easily. Check out all of my online training courses by going to the link on this screen, or easier still, just click on the orange button below. Until next week, keep green on your screen. Be careful out there. I'm Toni Turner, and this is The Market Now.